It's time to speak about a new fund offer that is currently open. It's the ICICI Prudential Mutual Fund Housing Opportunities Fund. And joining me to talk about this is Chintan Haria, who is the Head of Products and Strategy at the Fund House. Thank you so much, as always, Chintan, for taking the time. Could you tell us a little bit about what this offering is, what the objective is, and what segment it falls under when you're talking about the overall basket of equity mutual fund schemes?
Sure. So the fund is very simple, and I think it needs no introduction to all of us or any one of us. Housing is something which is close to all of us, and it is the most basic requirement of any human being. And we are seeing that as India is prospering and as Indian incomes grow up, as urbanization goes up, as more and more youth are getting employed, and as more nuclearization of families happen, the demand for housing has been quite strong. And in terms of timing, if we look at it, we are coming out of an 8-year trough as far as the housing sector is concerned. Till 2013, the housing sector was doing well. Then from 2013 to 2020, it went into a consolidation phase. And we are seeing an uptick right now, which we believe because of macro factors can continue in the near future. And it is one of the biggest drivers as far as our GDP growth is concerned.
Okay, so this is the thesis. Would it be right to say that this is a thematic fund? What subsection of the equity mutual fund schemes does this fall under? And it's not restricted to only developers, right? There's a wide ambit that allows the fund house to invest in a wide category of companies.
Sure. As the name suggests, the ICICI Prudential Housing Opportunities Fund is all about the entire housing as a segment. It's not only about developers, but if you look at the benchmark index itself, it encompasses banks and housing finance companies which provide the loans for the us buying the house. And I think that trend in India is growing pretty rapidly in terms of more and more people utilizing those loans. So that is one segment in which this fund can invest. The other segments, of course, include steel and cement with which the houses are made. And after that, once the house is made, of course, you need furniture, you need fittings, you need sanitary ware. All of it is part of the housing segment and the housing fund. And that basically ensures that it is a thematic fund based on the housing theme and includes subsectors which are related to housing. And I think we've seen over the last 5-10 years, many of these companies, including pipe companies, for example, seeing a significant growth because of the increased penetration. I think the roads being provided everywhere, the electricity being provided everywhere is also giving impetus to people moving towards pakka houses. And I think the interest subvention schemes of the government is also helping. So it's a diversified thematic fund in which you have housing as the core, and everything related to the housing can be part of this particular fund in terms of the exposure that an investor gets.
Okay, I want to speak about the underlying to a certain extent, and then after that we'll look at the benchmark and how it has performed. If we talk about the underlying, you mentioned at the start, the thesis, of course, is that urbanization is continuing. There is going to be an increased movement, like we've seen over the past several years, to cities. Nuclearization of families is going to force more people to buy houses, the affordable housing scheme and all of that. But you must have gone deeper than that. Give us a sense of how the housing sector as a whole, according to ICICI Pru, is going to shape up and where the opportunities lie, not just, as you said, in the developer space.
Sure. So if you look at in terms of the sector itself, and if you look at a rough ballpark figure, if, for example, 1 crore houses get sold, and if 50 lakh is the average house, depending on smaller city, larger city, you're looking at a 50 lakh crore potential that this particular segment can have in terms of addition to GDP, which is a good 15-16% potential from a GDP perspective. And that makes it a very large segment. And everything related to housing, be it pipes, cement, sanitary ware, steel, is something which will see a benefit of whatever is happening in India. And in terms of size, like you mentioned, we are seeing over the next 10 years, close to 25 crore Indians coming into the job market. By 2030, we'll have one of the largest middle class population. All of this means that 50 crore people are in the middle class, and our urbanization also is going to increase from the current 30-31% to almost 40-45% in line with the other Asian countries. You will find that the pace at which the new housing requirement will probably surprise us all in a positive sense. And that will also give not just a kicker to the GDP, but in terms of investors who are invested in this particular fund, they will get the benefit of it in the long run, because everything related to housing and housing connected sectors will definitely see a benefit of these increased demand as more and more demand comes for housing from the growing Indian middle class population.
Now, in terms of investments, if you talk about the real estate developers specifically, people have been a little wary of investing and going whole hog and betting on them because they have had troubled periods. In fact, before the pandemic, you had a situation where there were large amounts of inventory, and some of the schemes that were introduced by governments in Maharashtra, governments in Karnataka have helped clear up that inventory over the past couple of years. But there were a few issues in terms of financing and all of that. Could you help us understand what the concentration risk would be then? Because you're allowed to invest in so many allied sectors, you can reduce concentration risk. So what's the strategy with regard to the scheme?
Sure. So not just in the Housing Opportunities Fund, but at ICICI Prudential, we always look at the risk element and the diversification element subject to the boundaries that are set by the scheme information document. And even in the case of housing, the risks and rewards will be taken care while creating the portfolio. As you mentioned, there are various themes or various sectors which can be part of this particular portfolio, and the fund manager will definitely look at all the aspects, including the balance sheet. And you mentioned about the developer stress, etc. I think with whatever has happened in the last 3-4 years in terms of RERA implementation and the cleaning up of balance sheets, etc., and in terms of now the stronger hands in the developer space remaining and probably garnering a larger share in the market, this is also bringing confidence in the investors who are actually, or the consumers who are looking to buy houses, in terms of timely delivery. Plus the reduced interest rates right now have also helped affordability improve. So from an investor standpoint, if you look at the portfolio and if you look at the concentration, because there are so many allied sectors which can be part of the Housing Opportunities Fund of ICICI Prudential, you will not have to worry about a concentration risk in any of these one segments, because it will be a healthy portfolio in terms of you getting all elements of housing subject to the balance sheets. And this is the basic, right? Any stock that we buy or any portfolio that we create, the basic tenets of not having too much of concentration, creating a portfolio which is obviously not having stocks which have a balance sheet which can be of a worry to investors, and ultimately participating it in the right manner. So instead of developers, if you have, say, cement companies and steel companies which have good balance sheet, they can be a proxy to developers. And the good part is in India today, courtesy whatever has happened in the last 3-4 years, even developer balance sheets have improved considerably. And we've seen that translate into developers actually doing well in the markets over the last 1.5 years.
Okay, let's also reinforce this further, Chintan, to talk about the benchmark, which is the Nifty Housing TRI Index. Talk to us about the performance of this index over the past several years, and also the constitution of the index as it stands right now in terms of the sectoral contribution to this index.
Yes, so the index was launched a while back, and if you look at from an index perspective, there is a check and balance. No single subsector can be more than 25%, so that's there. Today, in terms of the construct of the index, like I mentioned, the largest portion is the housing finance part of it and the banking part of it, which is put together around 25%. Then you have the consumer names, then you have the cement, steel, metals, all put together around 11% each. So you have a good diversification which is there as part of the portfolio itself. You have pipe companies as well as you have energy companies which are also there. So if you look at the overall mix, which is essentially the gas utilities, etc., which form part of the housing. And overall, if we see from a stock perspective also, a single stock concentration of more than 10% is not allowed in the index at the time of rebalancing. So that is also taken care of. So in the index is quite smartly created, and that should help the investors also get a good experience from the way the portfolio will get constructed, because the index does not have concentration risk on the sectors because there's a 25% cap, and it does not have a concentration risk on the stocks because there's a 10% cap on the stock as well.
Okay, and the performance of the benchmark over the past several years, talk about that as well.
Yeah, so when we look at performance, we should always remember that themes, at what time do you enter in a theme becomes very important. And we've seen since 2000, maybe 12, 13, housing and related activities went through a lull. In fact, even steel, cement, etc. went through a dull patch till about 2015, 16. Real estate developers were in stress for a while, and only after 2016, 17, post demonetization, there was a pickup. So there was a time between 2012, 13 to 2016, 17 that probably this index would have underperformed the broader benchmark. And then from 2019, 20, if we see, the index has probably done better than the broader benchmarks. But the past returns should not essentially matter to an investor who's looking at this allocation in this fund. What should matter is that, do you have a goal of probably investing or buying a house for yourself, maybe 10 years, 15 years down the line, maybe 5 years down the line. And for that, if you want to create a corpus right now, which benefits from the housing sector growth, then this becomes a good tool. Also, those investors who are looking to probably book profits from, they are overweight in any particular segment where there is a lot of profits that they're sitting on, they want to diversify into a theme which probably has a good secular run over the next 5-10 years. That can be also looked at. So while past returns in the last 2 years have been very good, and that should not ideally be a consideration. We never say that past returns should be looked at when you invest. It should be overall asset allocation, and it being a thematic scheme, whether it fits your overall bouquet or overall portfolio in terms of your long-term allocation.
The reason why I wanted to speak about the performance is because I wanted to concentrate on the aspects within the basket that have done well. So you have the commodities plays, for example, the steel space that has done incredibly well, Chintan, over the last couple of years, right? But having said that, like you mentioned, when you were talking about the sector as a whole, there are periods of lulls as well. And in terms of the duration that an individual that you say should ideally hold this, you're talking about a 5 to 10 year horizon, which is a reasonably long period of time. And of course, equity funds need to be invested in with respect to a long period as well. But what are the pitfalls that one needs to be aware of? Because obviously this is not without a semblance of risk. Is there a danger in terms of the changing of an interest rate cycle? The worry that at some point affordability will come into play? How does one prepare for something like that?
So I think the risk is not so much a systematic risk in terms of the sector itself, because we do believe that this sector has legs for the next 5-6 years. But because of what's happening internationally, and as you mentioned, that the interest rate cycle in US is turning, interest rates are going up, because inflation is at a 40-year high and Fed is hawkish, we need to be conscious of the fact that world equities did benefit because of low interest rates and the liquidity printing that happened, where the US balance sheet went from $4 trillion to $8.5 trillion. That balance sheet coming down and the interest rates going up, or liquidity being sucked out and interest rates going up, would mean that equities globally will probably see a bit of volatility, and that would translate into probably Indian equities as well. And Housing Opportunities Fund, being an equity fund, will see that volatility also getting reflected. So I think it's more to do with equity as an asset class where volatility will be there, less to do with particular this theme, because as I mentioned, the 2013 to 2027 years of lull, typically real estate cycles are 16 to 18 year cycles, wherein you have 8 years of downturn or maybe 8 years of upcycle. We've seen 1.5, 2 years of upcycle in terms of demand, and next maybe 4-5 years, the demand may be strong, but the equities in terms of how they react will also depend, because we are coupled with the world economy. So if there's a downturn in equities, then this being an equity fund, that's the risk that we feel. And hence this should be treated as part of an overall investor's equity portfolio. And if your equity portfolio allows you to invest, you should invest in this. And like I said, book profits for somewhere where you probably have seen a lot of gains, especially if you look at international investing. I think the US market is at an advanced cycle. So you may want to book out of there and probably book some gains there and invest in this from a diversification perspective.
Absolutely. Okay. Use it to diversify your portfolio. Chintan, thank you so much for taking the time. This conversation has been useful, I'm sure.
Thank you.